Hi guys, welcome to the third of our application video. My name is Cormac and I'm one of your AAA module leaders. This video follows on from application video 2, progressing the audit of the wine store, and specifically focuses on the evaluation of misstatements and the respective impacts on the auditor's report. Before viewing this video, please ensure you have carefully read the background information for application video 3, and if you haven't already done so, please also work through the application videos and the live Q&A recordings for sessions 1 and 2. It's always worth re-emphasising that every audit is a process. Therefore, we encourage you to have worked through the scenario up to this point before tackling the areas of misstatements and audit reporting. So let's get started. Let's take a quick run through of the session outline and objectives. So today we're looking to understand what happens in the reporting phase of an audit. In particular, assessing whether we have sufficient appropriate audit evidence, evaluating the effects of misstatements, communication between the client and the auditor, and then deciphering the difference between audit opinions and audit reports. As with many audit questions, it draws on concepts discussed throughout the audit process and therefore across a number of earlier units. The concept of materiality plays a big part in evaluating misstatements and determining the appropriate audit opinion, and therefore you should be familiar with this and other topics as we step through the scenario. So how are we going to approach this? So we will quickly refresh some content and then tackle an exam style scenario, coupled with some quick quiz questions for you to try as we go along. As mentioned at the outset, we will ultimately work through how to ensure we, as the auditor, issues the appropriate opinion. And then we'll finish just by noting some key takeouts from today's session. So let's quickly remind ourselves about essentially the three high-level stages of the audit: the risk assessment, the risk response, and then the reporting phase. So the first application video looked at the risk assessment stage, the second looked at the risk response, and today we'll focus on the reporting stage. Make sure you're familiar with the relevant standards as we go, and as always you can either use international or local standards, as both will always be accepted in the exam. So at this stage of the audit process, the auditor is essentially addressing the question as to what audit opinion is appropriate on the financial statements based on the evidence obtained. We'll also later discuss the difference between an audit opinion and an audit report, which can also be impacted depending on the evidence obtained. So if you remember back to the second stage of the audit, responding to risks, we performed audit procedures with a view to obtaining sufficient appropriate audit evidence to reduce risk to an acceptably low level. It is now at this phase that we evaluate the evidence obtained. In doing so, the audit documentation is reviewed, misstatements are considered, issues are discussed and hopefully resolved with management, and the findings from the engagement are communicated to those charged with governance. Following this, the appropriate audit opinion is formed and issued. An area that requires significant professional skepticism and professional judgment, determining whether or not we have sufficient appropriate audit evidence is one of the more complex requirements an auditor must undertake. The auditor considers all relevant audit evidence in making this determination, and audit evidence obtained from various sources that is consistent will always increase the overall reliability of the evidence. Okay, so over to you here. What should the auditor do when sufficient appropriate audit evidence has not been obtained in the first instance? Do we immediately issue a modified opinion? Do we withdraw from the audit? Or should we initially attempt to obtain further audit evidence? Hit pause while you think about this, and then press play to continue when you have your answer. So if you selected the third option, attempt to obtain further evidence, then you are correct. In some instances, the auditor might not be able to obtain further evidence, in which case a modified opinion will be issued. But an initial attempt to obtain further evidence should always be made before this, and this is in accordance with ISA 330. Now that we're across a little of the theory, let's just revisit our case study very quickly. The wine store is a family-owned unlisted wholesale business selling wines from Australia, New Zealand and overseas to retailers, restaurants and event managers. In this scenario, you're an audit senior at AAA audit firm working on the audit of their general purpose financial statements for the year ended 30 June 2020X3, and you've just completed the risk response stage of the audit. So remember, this is the same scenario covered in application videos 1 and 2. And if you haven't read through the background information, please take a minute to pause here and do so before moving on. So in the background information, you will have noted that you have now performed all audit procedures and you have obtained sufficient appropriate audit evidence on all the material classes of transactions, account balances and note disclosures, with 2 issues being identified. So let's remind ourselves of the issues. So it has come to your attention that one of the wine store's trade debtors has gone into liquidation and will be unable to meet its liabilities. The amount owing to the wine store at balance date was $210,000. The second issue, sales subsequent to year end, highlight that certain items of stock had been carried at cost when they should have been carried at the lower amount of NRV. These items were overstated by $102,500 at balance date. So now we've understood the issues, let's look at the required and work through our necessary steps. So what does the required say? So for the first required, you've been asked to explain the impact of the 2 issues on the audit of the wine store's general purpose financial statements. So here, you've been asked to explain the impact of the 2 issues on the audit of the wine store's general purpose financial statements. So let's work through our methodology. So as we have completed our audit work and file review, the next thing to do here is to consider whether there are any misstatements identified as a result of these issues. So let's quickly look back at the first issue. The issue here is that a debtor relating to the wine store has gone into liquidation and therefore will be unable to pay the amount owing of $210,000. So as a result, there is a misstatement here and a correcting entry is required to rectify this. An overstated debtor amount results in a debit to the P&L through a bad debt expense account and a credit to the debtor account on the balance sheet for the full amount of $210,000. This entry would then be recorded on our summary of misstatements. So let's look at our second issue. So the second issue relates to inventory. Sales made after the year end have highlighted to you that inventory was being held at cost when should have been valued at the lower amount at NRV. So as a result, inventory was overstated by $102,500. So if it was overstated, what is the correcting entry for this? Take a minute to pause and then answer this yourselves. So what is the correcting entry to be recorded on the summary of misstatements for this issue? Take a couple of seconds to try and answer this one. So hopefully you've all correctly identified that there again would be a debit to the P&L and a credit to the inventory account on the balance sheet. As the adjustment relates to stock, the debit would likely go through cost of sales in this instance. So now we also add this to our summary of misstatements. So let's now look at what our summary of misstatements would look like. This type of table is a very common way of illustrating a summary of misstatements. It details the various correcting entries and groups them into their respective categories. For example, which entries impact profit and which affect the balance sheet. The total misstatements in this case is $312,500. Okay, so what do we have to do next? Once we have considered the misstatements, we must offer management the opportunity to resolve these. These issues will be discussed with management and the correcting entries put forward. If you remember from the background information, however, you were told that management are refusing to make any adjustments to the financial statements and that the audit plan does not need to be revised. So where do we go from here? So as mentioned, we need to consider the impact on the audit and the financial statements. As we are told we don't need to revise the audit plan, we move on to the impact on the financial statements. Management have not corrected the misstatements, so now we have to ascertain what our responsibilities are in respect of these. So let's take a look at the auditor's responsibilities with respect to misstatements. In line with ISO 450, the auditor must first reassess materiality to confirm whether it remains appropriate in the context of the results of the wine store. In this scenario, we have found two isolated issues that would not result in a change of materiality. The auditor then has to evaluate the effect of misstatements on the financial statements, both individually and in aggregate. And this has to be done from a quantitative and a qualitative perspective. That means we have to assess the size of the misstatement and also the nature of a misstatement. Okay, so let's first look at each misstatement individually and compare the size of each to the overall materiality figure of 300,000. The first entry is for 210,000. Hence, as it is below 300,000, this is individually immaterial. The next entry is for 102,500, so similarly this is individually immaterial. When, however, we look at these in aggregate, the amount of 312,500 is clearly above materiality, hence it is material to the financial statements of the wine store. As management are not correcting the material misstatement, this will impact on the auditor's opinion, leading to a modification. This flows into the second part of our required today. So the last step in this phase of the reporting process is to communicate these findings to those charged with governance. When it comes to communicating misstatements, the auditor has to communicate to management during the audit and to those charged with governance during the final stage of the audit. This is commonly done in a formal capacity by way of a board report, for example. So let's take another quick knowledge tester. So in addition to the points on screen, would there be any further communication, verbal or written, between the auditors and the wine store in relation to misstatements? So would there be any further communication, verbal or written, between the auditor and the wine store? Yes or no? If you think yes, what might that be? Have a think about that for a few seconds. So the answer is of course yes. The auditor shall request a written representation letter from management or those charged with governance on whether they believe the effects of uncorrected misstatements are immaterial individually and in aggregate to the financial statements as a whole. So a written rep letter. So now we've worked through the steps, let's revisit the required and see where we have got to. So the two exceptions resulted in misstatements which we have quantified and included on the summary of misstatements. We have understood the need to communicate these to management and those charged with governance. We have assessed the misstatements individually and in aggregate and concluded that the financial statements are materially misstated. And as management are refusing to make any adjustments, we know that we will have a modification to the audit opinion. You have not yet been asked to explain the modification, but as you know from the background information, this forms part of today's second question. Our second required is to determine and justify the appropriate auditor's opinion and explain any further implications on the auditor's report. As with any required, the key focus should always be on the task words. In this instance, you've been asked to do two things: determine and justify. So please make sure you're familiar with all the task words in advance of the exam. So before we look at the detail, it's important to understand the difference between an audit opinion and an audit report. The easiest way to explain this is by looking at the objectives of the auditor. So the objectives of the auditor are to form an opinion on the financial statements based on an evaluation of the conclusions drawn from the audit evidence obtained, and to express clearly that opinion through a written report that also describes the basis for that opinion. So essentially, the opinion only forms part of the overall audit report, but it is a major component of the audit report, and as such, it's presented first. The auditor needs to ensure that the correct opinion is included in the report based on the results of the audit work performed. Audit reports may also include additional sections and paragraphs depending on the type of entity being audited and the specific audit findings. So going back to our scenario with our friends at the wine store, we know that management have refused to correct the misstatements, which are material in aggregate. The opinion cannot therefore be unmodified. So just a quick note that the standards on screen 700 and 705 are the revised versions. So now the auditor must determine the type of modification that is required, and this will be continued on the next slide. So hopefully you're familiar with this table, which is included in your CSG. What this table does is summarize the types of opinion that should be issued, depending on the pervasiveness of the effects on the financial statements and the nature of the matter. So we know that the financial statements are materially misstated due to management refusing to correct the misstatements. Therefore, it is not through an inability to obtain sufficient audit evidence. We are therefore focused on the top row of the table. The second question you must ask is whether or not the misstatements are material and pervasive, or material but not pervasive. So what does pervasive mean? So determining if something is pervasive does require some professional judgment, and in reality this decision would really be made by the audit partner. Now ISA 705 describes pervasive effects as those that are not confined to specific accounts or items in the financial statements, or if they are confined, represents a substantial proportion of the financial statements. Now in this scenario, we know that the misstatements are confined to specific accounts and do not represent a significant proportion of the entire set of financials. We therefore determine that the effects are material but not pervasive, resulting in a qualified opinion. So we have now effectively answered the first part of this question. So remember to make use of all the information at your disposal. Let's see how your response might actually look in an exam. Just take a few seconds to read the suggested response to the first part of this required. Okay, so the only thing left to do is explain any further implications on the auditor's report. So what are the possible implications that we have to think about? The first thing to consider is the basis for opinion section. As we have issued a qualified opinion, this section must be titled Basis for Qualified Opinion, and the effects of the matters must be described here. Here we can see how the inventory matter might be described in the Basis for Qualified Opinion section. A similar description would be given for the accounts receivable matter in reality, but here we've just included what the inventory issue might look like in the Basis for Qualified Opinion section. So again, just take a few seconds to read as to what this might look like in an actual real-life audit report. So based on the information provided, the next thing to consider is the emphasis of matter paragraph. So let's remind ourselves what constitutes an emphasis of matter paragraph. An EOM highlights a matter that is appropriately presented or disclosed in the financial statements, which in the auditor's judgment is of such importance that it is fundamental to the user's understanding of the financial statements. So in the background information, we were told that after the end of the reporting period, 2 major suppliers were severely damaged by a large bushfire. So this constituted a non-adjusting material post-balance sheet event, which has been adequately disclosed by management. This therefore can be referenced in the audit report by way of an EOM paragraph. And again, here we can see how it might look in reality. So let's look at other potential ways an audit report can be modified. As an unlisted entity, and with no annual report coming before the date of the audit report,
there is nothing further to suggest here that an other information section is required.
Key audit matters are only required for listed entities, but in some cases with a non-listed entity, a key audit matter can still voluntarily be included when the auditor wishes to provide greater transparency around a specific part of the process. But again, there is nothing in the background information which suggests this could be included in the audit report for the wine store. The final thing to consider is whether or not there are any going concern considerations. In this scenario, however, there is nothing to suggest that management's use of the going concern basis of accounting is inappropriate, and there is no material uncertainty around this. Therefore, there is no implications for the audit report from a going concern perspective. So we have now answered the second part of the question. So in summary, we must include a basis for qualified opinion, describing the qualification. We must include an emphasis of matter paragraph, drawing the user's attention to the respective note in the accounts. So hopefully you were able to follow these steps and understand the rationale behind each. So congratulations, we have now answered both requireds. Now we've gone through the requireds, whilst they're still fresh in your mind, perhaps it's worth taking a minute or two just to jot down any questions you might have that you might want to raise either in the live Q&A session or via the discussion forum. So before we finish off today, let's just take some key takeouts from today's session. So remember that the reporting stage of the audit includes evaluating evidence as well as reporting on it. It's important that we always understand any issues and what the respective adjusting entries might be. So what are the implications of management not correcting misstatements, both on the audit and on the financial statements? And then what communication is required between the auditor and the client? We've looked at what the difference is between an auditor's report and an auditor's opinion. What constitutes a modification or an unmodified opinion? And then the ongoing implications for the auditor's report for things like an emphasis of matter. So as I said, thanks very much for taking the time to look at today's video. If you have any further questions, please feel free to take a note of these, and you can bring them up either in the live Q&A session or via the discussion forum. We hope the video was useful, and good luck with the rest of your studies. Thank you.